Hello and welcome everybody today. My name is Kathleen Hayes. I am the Global Economics and Policy Editor at Bloomberg Television and Radio. I am very pleased and excited to be moderating this panel for the Chicago Council of Global Affairs today at a time when there is so much unexpected and probably more than what we expected this year to watch in terms of where the economy is heading, not just in the US, but around the world. And I want to thank everyone on YouTube for joining us. The public portion of this program is going to go for about 40 minutes. We're going to put all these issues on the table. We're also joined on Zoom by members of the council itself. They'll be engaging with us in a more private Q&A session after we finish the public portion. Here's my disclaimer. The Council is an independent and nonpartisan organization. It takes no institutional policy positions. Views expressed by participants on the program are their own. And believe me, I've talked to them, and I think you're going to hear some very interesting views expressed throughout this today. Let's start with Paul Burroughs. He's the North America Head of Corporate Banking. He's the Global Chief Operating Officer of Citi's Corporate Bank. Paul, we welcome you. John Carson, Senior Vice President of Retail at Blue Yonder. He leads the North America Retail Business Unit. He works with all kinds of CEOs, retailers, multinationals in the US and around the world. Betsey Stevenson, thank you as well. Professor of Public Policy and Economics at the University of Michigan, go Blue, and formerly served as a member of the Council of Economic Advisors and is the chief economist for the US Department of Labor. So at a time when there's so many questions about labor markets and what's going on, we're just very pleased to have her as well. So think about it. When we came into 2022, didn't it feel like, oh boy, we got through the pandemic, the reopenings are happening, there's still a lot of issues, but the economy's back on its feet, we're moving ahead. And then all of a sudden in March was March 20th. Hard to believe it was just 3 months ago, Russia invades Ukraine, and so much now is changing again. In fact, inflation, which has been hovering like a darker and darker shadow over the economy, over businesses, over policymakers, certainly over the Federal Reserve, is suddenly on fire. And we're seeing this expectation that the Fed may have to be on fire too with its rate hikes now. We've seen the meltdown in stocks the past couple of days really bad, but this is getting us into a bear market now. We're looking at bond yields surging again. That was a big red flag for the Fed going into the pandemic and that big pandemic response back in March of 2020. Paul, I want to start with you. You're in finance. You're dealing with people who are in the markets, managing their portfolios, et cetera. What are you seeing now for the Fed? What are you seeing, the messages being sent here?
Yeah, thanks, Kathleen, and good afternoon or good morning to everybody, and appreciate the opportunity to talk a little bit about here. I mean, I think the Fed's in a challenging situation, right? We're trying to, from an economy perspective, as you touched on a little bit, the meaningful challenges around the world. We have energy and commodity prices. There's tremendous market volatility. We have supply chain disruptions and heightened uncertainty. I think, inflation in the US is, 8.6% now. And the Fed, I think, is trying to balance a soft landing here. And I think there's a lot of discussions in the marketplace of where does this look like next year, next 12 months, and are we going to hit to a recession? So I think the Fed has a difficult challenge going forward in trying to manage how quickly they're going to raise interest rates and not push the economy into a recession. So, I think, client sentiment, there's still a lot of uncertainty from clients around the world. I think the balance sheets in the U.S., as we talked about the other day, tends to be strong. And I think CEO confidence is still relatively high in the U.S., but there is uncertainty in the next 12 months that we're very concerned about.
So I want to turn to you, John, to go to another big issue very recently, because it was the big tech names that started this meltdown in stocks. But recently now it's big retail names as well. If you look at Walmart, if you look at Target, stocks have also been hit pretty hard. And one of the things driving this that came out of the earnings out reports and outlooks was inventories have built up hugely. We've gone to pandemic spending rapidly to post-pandemic what? What are you hearing from retailers? What are they concerned about, especially at a time when they know the Fed is not going to let up for a while, or at least that's what it looks like?
Yeah, retailers are focusing today on that very thing, Kathleen, their inventory levels. I think they found through the pandemic, they wanted to be the retail store that the consumer could count on to have their shelves stocked. We saw rising inventory levels across retailers because we thought the demand would continue. I think we're seeing this economic downturn maybe affect how the consumers are spending, and retailers have been caught, like Walmart and Target have recently announced, and recently Abercrombie and Fitch as well. 10, 20, even 30% over inventory. So they're finding themselves in a strong inventory position, maybe too strong now. So that will lead to markdowns and maybe excess inventory costs. So that will impact how they move forward on their inventory levels, which is very difficult as we go through this, as Paul mentioned, the increasing and repetitive supply chain disruptions. What do I do with my inventory, and how do I place it closer to my consumer so I can fulfill that consumer need? So it's a real issue for the nation's top retailers.
Well, Betsey, you've been a policymaker. You've worked in the White House. You worked for President Obama. So you've been up close and personal to these kinds of issues. Does the Fed, I'm going to ask you the big picture question, does the Federal Reserve have to be willing to risk a big slowdown in the economy, risk a recession in order to bring down inflation, which, according to the latest report, where we thought we might see some glimmers of hope, it's starting to peak and come down. Looks like some of the key elements are pushing higher again. And importantly, we're seeing inflation expectations on two major reports starting to indicate that they're continuing to move higher among consumers and households.
So first of all, you said the word risk. Of course, they have to risk a recession. The question is, how big is that risk, and how do they respond to that risk? So first, I want to step back for a second, because I feel like so far the conversation has started in a really narrow framing way. We just saw this huge bear market that scared everybody yesterday. If I had told you in January of 2020 that we were going to have a pandemic that would shut down the economy for 3 to 6 months, that would kill 1 million people, that would sicken tens of millions of people, and the stock market would be up 12% at the end of that, you would have thought, well, that's a great outcome. And that's literally where we started this morning after the bear market. Retail sales, you guys have built up a ton of inventories. If I had told you that your sales would be up 17% over where it had been prior to the pandemic, you'd say, no way, that's a great outcome. So we have to think about, expanding a little bit about, well, how did we get here? Let's have some gratitude for the space we're at, because I worked through the 2008 recession. And let me tell you something, if we thought in 2008 that we could have been in 2011 where we are in 2022, or 2010 where we are in 2022 following the 2020 recession, we would have been amazed. We didn't get anywhere near that. It took 8 years to get unemployment below 4% after the 2008 recession. So what's happened is, I think policymakers did what we absolutely needed them to do, both fiscal and monetary policy. They put a ton of support behind the economy. Turns out that producers couldn't quite keep up with the amount of support they put out there. Maybe you'd say, well, they shouldn't have put so much support out there, but it's kind of hard to know. Normally, supply is what economists would call a little bit more elastic, meaning you respond a bit faster. You do what retail did. Retail did respond. Retail kept the shelves stocked. People came and they bought the stuff. There's only so much retail people can buy those. So there's a little bit of adjustment going on there. But the bigger problems were things like autos, where they just didn't get the chips. There weren't cars. The durable goods, where they just couldn't get things. So we had bigger supply chain problems than anybody anticipated.
Right. But I think, Betsey, the problem that people are really concerned about now is inflation's at a 40-year high.
Absolutely.
A 40-year high, and the idea is it's going to take some aggressive action to bring it down, and what the fallout's going to be.
The only thing
that I think is the concern that the average American is looking at now too. Yeah, it's great we got through the pandemic, and some really good things happen, and that's all the more painful than maybe that it seems to be kind of, to a certain extent, looking threatened before your eyes.
But the only thing the Fed can do is bring down demand. That's its only toolkit. It's got to lower demand. So this comes back to your question. Do they need to risk a recession? Of course, anytime you're going to bring down demand, there's a risk of a recession. The question is, can they get the Goldilocks economy? Can they bring down demand enough that they don't get a recession? No one can predict whether they're going to get that right. We're all hoping they get that right? And then there's the question, do we need to see a 75 basis point rise tomorrow? Do we need to see a 50 basis point rise? Do we need to see a 100 basis point rise? What do we need in order for them to get us that soft landing? I think that's the thing that's what everybody's freaking out about right now, because they don't.
Yeah. And I want to get to supply chains next, but first a quick follow with you, Paul, because there's a lot of concern about, they say the old saying about when the tide goes out, you can see who's not wearing the swimming suit, right? And that's a whole thing about debt, corporations, and small businesses too, everybody. From your conversations, from your feedback, or what you've seen, is there a risk that the debt issue for corporations exposes those that maybe didn't prepare for this quite as prudently as they could have?
I think, Kathleen, and I'll touch on a little bit about what Betsey said, the last 2 years in the capital markets, if you needed capital, you had access to it, and you had access to it at very cheap rates. And I think most of the corporations, and I cover global multinationals, the large Fortune 500, they had access to liquidity. They brought down their cost of capital by refinancing into a cheaper market. I think they have a lot of liquidity on the balance sheet, a lot of cash on the balance sheet. So I think the clients that have taken a longer term view are going to be in pretty good shape. Now, if you talk about, private equity that leverages up the companies they buy, interest rates going from, 2% to 5% on the long term, just talking points in time, right? They may be a little bit more challenged. They have a little bit more volatility and less room for changes in the marketplace, I would say. But I think overall, the global multinationals will be in very good shape. And I think for what they've done over the last 2 years, and that access has been very good. I would just, one more thing to say, they still have access today. They still have access to the capital markets. I think the leverage finance markets have really come off a little bit. But if you need to raise capital today, you could still do it in the capital markets at a different point in time from a cost perspective. But I do feel comfortable that people could access it if they still need it. Okay.
And now to you, John. Do you have anything you want to add here before I get you to tell us about supply chains? I assume that retailers are pretty good. Financing isn't the issue. It's other things that they're concerned about now.
Yeah, the cost of money is fine, as Paul mentioned, right? What they're worried about now is they see their increased costs coming. Do they absorb that as far as lower margins, which obviously Wall Street doesn't like that performance, or do we pass that along to the consumer? And there is a genuine concern at the executive level across the top retailers about passing on those costs to the consumer, because it reduces their consumer spending behavior, right? And so it's trying to balance those two things in the market today.
Well, tell us a bit more. You have you do a lot with supply chains. That's your area of expertise, and that's what you help so many retailers manage, figure out, et cetera. You the RELA group is CEOs of some of the biggest retail linked companies in the country. What can you tell us right now about how companies are being affected? Betsey brought that up too. It's clearly been an issue that nobody could foresee, but it's clearly also an issue that is not over yet.
No, and I think what we've seen from the pandemic is, it started as a medical issue, or a health related issue. Then we saw like the Suez Canal scenario. So what we've seen is the supply chain is continuously disrupted. So what we're working with retailers and manufacturers alike is not only how do you have advanced visibility to supply chain issues, but how do you react to them, right? Because we ultimately want to ease the constraints and make those goods available for the consumers to buy. So where we're working with the retailers today is how they react to that and better plan for the supply chain disruptions. Because I think, not to use an overused term from the pandemic of the new normal, but these disruptions will be the new normal. We'll continue to see them. And you have geopolitical issues. You have the war in Ukraine, who's affecting, how things come from overseas. And maybe the number one thing here, Kathleen, is the incredible increase in cost of ocean freight today, right? I think we've seen the 9 major ocean freight container shippers, raise their rates 700, 1,000% over the last 2 years, right? So there's active legislation, and you mentioned RELA, it's the Retail Industry Leaders Association. I work closely with that organization, sit on the board, and they're actively trying to impact the Ocean Shipping Reform Act of 22, where we're trying to give the Federal Maritime Commission more power to limit the increase in fees, because those fees increase the shipping costs, increase the cost to the retailers, who then pass those costs on to the consumer. So anything we can do there to help ease the pain for the end consumer is really the goal of the North America retail organizations.
Betsey, I know that onshoring, nearshoring, I think it's something everybody's watching, but I know given your expertise, your time looking at trade issues as well, but particularly with this, what's the outlook for that? Is that something that's going to help? Is it something everybody's going to talk about now? But if the supply chains, just when they get cleared up in a couple of years, everybody will say, let's go back to how it was.
So I think this is a really important point, which is we gained enormous efficiencies that fueled economic growth for many decades that came from being able to very inexpensively. And when I say inexpensive, I don't mean money. I actually mean resources. Being able to get things from point A to point B using very little in resources because we got so efficient. The pandemic blew those efficiencies up. And that's a real loss to us. So it takes more time and energy. Ships are sitting in dock longer, so they got to be shuffled around, or goods have to be unloaded into a storage facility and then removed. So it's taking more people's time, it's taking more resources. All of that's a loss. It makes things more expensive. And that, we could reshore them, but the reason we offshored them was because it was more efficient. It allowed us to consume more for less. Onshoring it is not going to let us consume more for less. It's just going to bring it back in and accept these losses as permanent. We don't want to accept these losses as permanent. We'd like to get these efficiencies back. And I think that is really important. And the other argument people give is they're like, oh, this globalization, it's so risky. We're really getting hit hard by Putin's invasion of Ukraine. Absolutely. But what it is when we globalize is we risk share around the globe. So right now, we're getting somebody else's risk and we don't like it. But you know what? In 2008, they got our risk. They didn't really like it, but it actually prevented our economy from being even worse. Sellers were able to export when consumers weren't buying in the US market. And that prevented companies from doing quite as poorly as they would have. Right. So globalization brings these kind of benefits. And I want to come back just to one thing, John, you said that I think is really important that we realize. There is a clash in incentives here right now, because if you're a retailer, you do not want people to buy less clothing or less stuff. If you're the Fed, you need people to stop buying as much stuff, because it's the buying all this stuff that's been pushing up prices. So the Fed's going to try to give people incentives to buy less. That is not what companies want. They don't want to see people buying less. So they're like, yeah, buy less of somebody else's stuff. Keep buying my stuff. And that's sort of the fundamental problem. So when we talk about the Fed looking for the sweet spot, we want them to pull back a little bit so that, retailers can bear the pain without going through massive layoffs and businesses going out of business. So we need to cool demand. And cooling demand is not something anybody likes, but it's absolutely what's needed to bring prices down.
Did you want to comment on that, John?
Yeah, no, the only thing, it's a great point there, Betsy. And the only thing is, 2/3 of the spending in retail happens at the top third level of the economic spectrum, right? I've got customers and work with customers like Dollar General who have 18,000 stores where their average consumer has $60 at the end of the month in discretionary income. So they take it very seriously that I have to provide those consumers with the right goods and services to spend their dollars wisely. So when they see these costs coming up, which we're trying to help them manage, they're saying I can provide less services and goods to those consumers with lower spending power. So those at the bottom of the economic chain are impacted even more by these rising costs.
Well, that's a problem with inflation. They call it the cruelest tax of all, don't they? And Paul,
absolutely. And Kathleen, let me just add one more thing, which is if we think about the supply chain, those costs we're talking about, that's part of what's been driving inflation. And it's painful because if it's taking us more resources to get stuff, it means we need to have less stuff. And having less stuff when you're at the bottom part of the income distribution is a real painful cut in your living standards. So this is, economists can make the math sound really simple, but the reality is that somebody here gets hurt. And the question is who and how do we spread the pain in a way that minimizes, some people getting devastatingly hurt.
And I think, Kathleen, just one last thing, the globalization, as Betsey talked about, and, the interdependence of the markets and economies is really getting shaken at this point in time. And I think if you think about companies that use products coming out of Ukraine, auto manufacturers that use wiring out of Ukraine, they have to rethink. And I think and Betsey would be better knowledgeable than I, we've been in a just-in-time philosophy for the last 10 years. I'm not sure in the near term we can do that again. It has to be just in case. It has to be a little bit more inventory because you don't want to be on the other end and saying, I don't have product if my customer wants to buy it. That's even a tougher situation. So I do think that globalization will change. We're uncertain of how we will do that, and whether it's supply chain or banks using working capital solutions to help our clients through that period of change. It's something that we're all thinking about. Sorry, go ahead. Of course,
another shortage, disruption has been labor shortages. Who thought that we would have a time when there were jobs, I think there's still roughly about 2 openings per person who is looking for a job in this country. So that's the average. Nevertheless, this is another big shift. And John, I wanted to come back to something you have said about how you're saying that companies, retailers have been trying very hard, and you kind of alluded to this, to not pass on costs, right? Mm-hmm. But they really need to get workers. You can only substitute robots for workers, and there's certain jobs you're never going to substitute, in my view. I like people over robots myself. But do you think this is something that's going to start changing now? This ability for retailers to say, well, we'll do what we can, because you can, again, you got to get the workers, and maybe this will be the easing though. Maybe that's the thing that's going to happen that Betsey alludes to. If there's less demand, I guess you won't have to, the wages won't go up as much and the cost won't be passed on as much.
Right. Now, the 2 things there from the customers I work with, they want to provide a nice living wage for their employees. Retail are typically are on the lower end of that scale, and they're trying to give them a competitive wage so they can, have a high quality of life. What I'm seeing from the workers, you mentioned the robots there, so I'll go on that for a second. We've had that ability from a technology standpoint to augment the workforce for years, but there was an unpopular opinion, I guess, that we were replacing human jobs with machines and computers. I think what you're seeing today in retail is a higher adoption rate of artificial intelligence, machine learning, technology to automate the decision making, but it doesn't replace humans. It allows those humans to get out of the day-to-day tasks they're normally doing and really focus on optimizing their decisions they're making. Also seeing robots widely used in the distribution network, more on the warehousing side, right? I can move goods 24 hours a day through a warehouse using automation and robots, not replacing humans. Humans are now providing, less of the repetitive task and more of the decision making. But you can see the blend of human workforce and automation through technology really helping move the supply chains.
So Betsey, wages, some people are concerned about a wage price spiral. Wages, the average hourly earnings from, as measured by the jobs report, they came down a little bit in the last report, but they're still over 5% year over year relative to the range that prevailed before, which is something like 2 to 3%. So they're staying higher. Do you take, is that a serious risk? And I guess what I'm also wondering is about, as a labor economist in particular, unemployment. What kind of unemployment rate? What kind of increase do you think? And I know it's all back of the envelope. Or is it magical thinking, like the Fed seemed to say at one point, oh, we can raise rates and fight inflation, but unemployment's barely going to move. Recently, Chris Waller from the St. Louis Fed said it'll be, what do you say, a masterful act if the Fed can achieve what it wants to do, which is slow down inflation and not have the unemployment rate going up above 4.2%. That would still be a relatively low rate, but how do you connect those dots?
Well, let's start with labor force participation. And labor force participation has come back at a pretty rapid clip, again, compared to previous recessions, but it's not all the way back. But if you just even look at last month, where we're averaging 400,000 jobs added a month, just in the last 2 months, that's an amazing pace of job growth. That's not a sustainable pace. That's a recovery pace. Now, and so people are coming where the unemployment rate's not falling as it should be. If you're adding 400,000 people a month, it's that we're bringing more people in from the labor force. So we're adding to that recovery. There's something that rarely gets talked about, which is that we're missing a lot of foreign-born workers. So if you looked a year ago, we were missing over 2 million foreign-born workers compared to the pre-existing trend on how many immigrants we should have. So we just had a lot of people who decided this pandemic's not for me, and they went home. And then we had a lot of people who didn't come in. And the result has been a decline in the immigrant workforce. We've actually just in the last few months started to see that reverse. Okay. So that's been something that's been adding to the pool of available workers. When we think about, does the unemployment rate need to come up? So you brought up the point that we have all these job openings. The job openings remain a puzzle because the job openings are so high that if we filled every single one of those job openings, we would be about 3 million people above trend for where employment would have been if we'd never had the pandemic. So do they really want to hire all those people? What is going on? Are they worried about turnover is so rapid right now that they're posting a lot of openings so that they're, now, so they've moved away from just-in-time inventory to just-in-time hiring. Like, I want to be ahead of the game. I want to be advertising for positions that I might have next month. That could be part of what's going on when we do see that there's a lot of hiring. So now let's turn to wages.
Okay.
What are we seeing with wages? Wages are going up for people who are newly hired. They're not going up for everybody else who's sticking around, and they're going up the most at the bottom. So okay. Dollar General's got the biggest problem here because it's hard to keep paying people $9 an hour right now. Mm-hmm. We're not seeing big wage increases in the top half of the distribution unless you're really changing jobs. So we're seeing that growth primarily at the top. None of that is indicative of a wage price spiral yet. Okay. And the wage price spiral happens when workers look over their shoulder and see, what? Prices went up 8.5%? You better be giving me a 6% raise this year or an 8% raise. So you give them the 8% raise and then you raise your prices again 6% or 8% because you got to make up for the raise. And then we're off to the races, and that happens year after year after year. We don't see signs of that yet, but oh my God, is the Fed frightened of that happening right now?
All righty. Paul, I don't know if you want to comment on this. I know another thing that you are watching very closely and is a big concern, and I'm sure that John and Betsey are watching this too, but China. This was another thing people didn't really expect in 2022, right? The Chinese insisted that COVID-0 was working. Well, guess what? When Omicron comes along, COVID-0 obviously doesn't work so well. So they shut down again. They started opening up. It looks like Shanghai is, having to shut down some more. The slowdown, how is that affecting the outlook for corporations? What they need? Where do you think that is as a process or as in a dynamic right now for business, for workers, for the economy?
Yeah, I think we touched on this the other day a little bit. I think the stability that the Chinese economy has had over the years is in a state of flux, right? I think their growth target this year is 5.5 or somewhere thereabouts. I think there are concerns about continuing downside risk I think they're having challenges, as you just mentioned, with, zero COVID policy, the ongoing lockdowns, the property sector is under stress. And I think we talked a little bit about this earlier. China was a big supplier to supply chain, and uncertainty of how they are going to be on the spectrum as we think about the war that's happening with Russia, Ukraine, the challenges we had with previous administrations, their impact to the global growth slowdown in exports. So I think it's something that's going to have to be thread through a needle a little bit of how we're going to continue to engage with China, who's a big player in the global economy. But it does have an impact on how we're thinking about our growth, the growth that we had delivered with China over the years. So it's a challenge.
So John, and we'll bring Betsey in last because I know she is, I'm sure, watching very closely the fact that the Biden administration is thinking about, removing some tariffs. But right now, if I said, John, what does this mean for retailers? Is it made their job a lot harder because they can't get the goods that they would have gotten in the past? And we get so many manufactured goods that go to retailers in this country. Is it a possibility that this is something that, again, people are hoping will change, or they're already adjusting what they're doing when they try to figure out, what kind of investments they're going to make, what they're going to do in 2022, going into 2023 and beyond?
I think a key theme in conversation that's happening today is, we've talked about this, I call it dependence on China, but it's really that globalization, that optimization, and it drove, a lot of growth for us for a long time, as Betsey called out. But the conversations I'm part of are, do we move some of that to nearshore production and some of that onshore? Not everything, we'll still have a large production of goods coming from China, but when I have a supply chain disruption or I have a demand spike, I could meet that in a shorter lead time from nearshore or onshore. But that comes at a higher cost to the consumers or to the retailers and manufacturers. So you'll see them kind of balance that. From a retail industry standpoint, two key things, and you touched on the Biden administration, that's really key. There are labor negotiations going on with the International Longshore and Warehouse Union and the Pacific Maritime Association. Those contracts expire on July 1st, and we have to get those resolved. Otherwise, we're going to see the ports have a work stoppage, right? And then we're going to have a whole nother level of supply chain disruption there. So the Biden administration is working hard to solve that. And then I think we'll see action next week, hopefully by Congress, on the Ocean Shipping Reform Act, which should help us pull down these costs a little bit for the retailers and manufacturers.
In a nutshell, Betsey, what do you think is going to happen with the trade, with the tariffs? I mean, there's a lot of elements, but in terms of, you have to make one main point here. What is it?
People do not want to see, this is the problem President Biden has. They don't want to see him be, quote, weak on China, and they don't want to pay high prices. So they're pissed at China for selling us cheap stuff, but they want to keep buying cheap stuff. So what do you do if you're President Biden? I mean, that's for his political advisors to say. As an economist, I'd tell him to cut those tariffs right now because people need relief on these price increases. And the Fed raising rates is a pretty blunt instrument for bringing down inflation. And I think we should use every tool we have. And one of those is reducing tariffs. But I'll tell you, presidents don't always listen to their economic advisors. They tend to listen to their political advisors. So I don't know what those guys are going to tell them.
Quick follow on that, Betsey, because this is something I've been thinking about as we've been talking. I mean, okay, globalization's great and onshoring and nearshoring, maybe people forget about it. But is it possible that, especially after people have gotten used to paying higher prices, they don't like it, it hurts the poorest the most, et cetera, that, a little onshoring, a little nearshoring might actually mean that there's more goods produced in the United States. We do create more jobs. Manufacturing jobs used to be good paying with good benefits. Is there any chance that happens?
Manufacturing jobs as like the source of good pay with good benefits is a form of nostalgia for a past we're definitely not going back to. I mean, if you look over the last 50 years, we have not really added any manufacturing jobs in 50 years. We've added about 75 million service jobs.
Yeah, but that's because the Chinese had such low wages overseas. Why would you add manufacturing jobs in the US?
Again, remember the next number, 75 million service jobs. Our economy has grown enormously.
Okay.
Manufacturing is about 15%. So let's say we had a huge 20% growth in manufacturing, and we could bring it up to 16 or 17% of our economy. It's still tiny. And it's still going to be lower paid jobs because people don't want to pay $2,000 for an iPhone that's assembled in the United States.
Okay.
And that's the fundamental problem is, if you let's take clothing, because 40 years ago, almost all clothing was manufactured in the United States. Now almost none of it is.
Okay.
What did Americans get for that? They have more pieces of clothing than they can use, and they're spending only 2% of their budget on clothing. So they're not willing. They might say they're willing to pay a lot more but I'm telling you that the cost is much bigger than anybody anticipated. All
right. I want to bring in another point, and I want to go right to you, Paul, because this is something that you're involved with, and I know it's a concern to everyone. But in terms of ESG, net zero policy, how the challenge now, and I think particularly right now, because one of the big debates, say, within the energy industry, particularly in the US, is they feel that they're being told to pump more, but they're not getting any kind of assurance that in 2 years, if prices come back down and there's plenty of energy, that all those investments they make now aren't going to be pulled out from under their feet, right? Because they're going to be still very strict. But overall, as somebody who's worked with this, who's in terms of with companies and what they're trying to do, what do you see and how does it work into the economic outlook?
I think, the first thing, we've spent the last 50 or 100 years growing our economies on cheap fossil fuel, right? And let's just assume it's 100 years for a second, Kathleen. We're now saying in the next 30 years, cut that by over half, we have to get to a net zero perspective. That's a huge challenge. And you really can't underestimate the challenge that we face in combating climate change. I think we were moving in that direction. The war happened. Pricing for electricity, natural gas, obviously, oil and gas prices, we all see it every day, has kind of stumped that a little bit. And I think we're going to need businesses to make the right investments to make the shift for that demand supply. I think we need the governments to create new policies to stimulate demand for clean technologies. And oh, by the way, don't forget the consumer. The consumer has to pay for this. So the consumer demand will change. How quickly the producers will have to change will be somewhat dependent on how the consumers push it. So I think there's a lot of things that are going on, but it's going to take business, it's going to take governments, it's going to take fiscal policy for all this to come together. And the next 30 years may seem like a long time, but it's coming quickly. And I think as a bank, we're focused on it.
What's coming quickly, of course, is saying goodbye to our public audience on YouTube. But didn't I tell you guys, audience, that this is going to be a great conversation? I wish I had at least another hour with these three to continue to talk about things and say, why did you say that? And what do you think about that? So we're going to continue now with the Q&A as we with our on our council social channels and website very shortly. For the council members joining us through Zoom, stay on. We'll be getting the off-the-record Q&A momentarily. And quickly, for the public audience, big round of applause. Let's do it in the other direction this time. Betsey Stevenson, Professor of Public Policy Economics at the University of Michigan, Paul Burroughs, North America Head of Corporate Banking and Global CEO of Citi's Corporate Bank, and John Carson, Senior Vice President of Retail at Blue Yonder. And I think if you look at any of their work, any of their references offline, you're going to find a whole lot more interesting information and ideas. And we thank you all. And again, council members, we're going to keep this Q&A going. So I hope you're ready to ask them a lot.